Coming up on Market to Market, President Obama proposes a record $3.8 trillion annual budget. USDA enjoys a modest increase in its funds, but some subsidies appear to be doomed. And the next leader of China travels to the heartland to rekindle friendships and expand opportunities for trade. Those stories and market analysis with Walt Hackney and Virgil Robinson next.
Funding for Market to Market is provided by Pioneer Hybrid, which supports efforts to help families pass their farms into the hands of the next generation. Pioneer, science with service, delivering success.
This is the Friday, February 17 edition of Market to Market, the weekly journal of rural America.
Hello, I'm Mark Pearson. Last year, China purchased an estimated $20 billion worth of U.S. agricultural products as the booming Chinese market became the top foreign destination for U.S. farm goods. The development was not exactly a surprise. With 1.3 billion residents, China accounts for 21% of the world's population. Yet the developing nation is blessed with only 9% of the planet's arable land. According to the Agriculture Department, U.S. farm exports to China supported more than 160,000 American jobs in 2011. At an annual agricultural symposium held at the headquarters of the World Food Prize in Des Moines, Iowa this week, U.S. and Chinese leaders signed a plan of strategic cooperation to guide the two countries' agricultural relationship over the next 5 years. The guest of honor was Chinese Vice President Xi Jinping, who is widely believed to become the next president of China. The stop was one of several in Iowa, and as Andrew Bott discovered, Xi's whirlwind tour fostered positive relations between the two nations, expanded trading opportunities, and reunited old friends.
Well, I want to welcome Vice President Xi.
Nestled between presidential meetings in Washington and a jaunt through America's most populous state of California, the presumed heir apparent of China's presidency visited the Corn Belt this week. Chinese Vice President Xi Jinping swept through the agricultural powerhouse of Iowa, visiting a local farm and joining the state's governor for a lavish dinner.
Subnational cooperation is an important foundation for China-U.S. relations. Over these last couple of years, subnational exchanges and cooperation between our two countries has literally flourished. And Iowa stands at the forefront of subnational cooperation between China and the United States.
We are proud of our mutual beneficial trading partnership with China, and Iowa farmers are proud to harvest safe and reliable agriculture products for use by the people of China.
Dining on pork and bacon-wrapped beef, the dinner was part business, part reunion for the next leader of the Asian superpower. In 1985, Xi, then a provincial Chinese official, joined a small group of dignitaries for an agricultural tour through Iowa. His rural hosts treated Xi to warm meals and lodging. His visit long sat as a foreign footnote to history. Fast forward 25 years, and that little-known provincial official now seems destined for the presidency of the world's most populous nation. And in a camera-friendly tour through America, Xi returned to Muscatine, Iowa, and friends not long forgotten.
Some other old friends? It is a joy to have you back in Muscatine.
And I remember you took us to a few farms and we had picnics together.
But the Chinese leader didn't stop in Iowa solely for a friendly reunion. Iowa leads the nation in corn, soybeans, and other commodities, and is a direct beneficiary of China's booming economy. Governor Terry Branstad, a 5-term veteran who weathered a disastrous farm crisis in the 1980s, envisions Iowa farmers can ride the wave of Chinese demand. And for Midwestern growers, the rising tide shows few signs of cresting anytime soon. Over the past decade, Chinese purchases of Iowa commodities have skyrocketed, from less than $25 million in 2000 to nearly $600 million in 2010.
Well, I know the output on your farm is very large, so how do you read market signs and signals to see whether you will be able to sell all your produce?
That is probably the toughest part of farming, is to market our crops.
Iowa corn and soybean farmer Rick Kimberly hosted the Chinese leader at his 4,000-acre operation. He believes the Asian power is a premier buyer of U.S. grain today and well into the future.
They export 55% of the soybean that's grown in the nation, not only in Iowa, but in the nation. And 60% of that number is exported to China. So that's a huge number.
The numbers are staggering. According to the Iowa Soybean Association, 1 out of every 4 rows of U.S.-grown soybeans is bound for Chinese markets.
Vice President Xi, we'd like to offer you these gifts.
And that's a major reason why Kimberly and many farmers rolled out the carpet, toy tractor gifts, and a welcoming hand to Xi Jinping.
So we have a good system where we don't have spoilage, and we can keep the corn and soybeans in good conditions to where we can deliver it.
But China's global status as a major creditor of U.S. debt and growing influence in international relations has soured some impressions in America.
How many people are needed to operate this machine?
One person, I or my son Grant will drive the combine.
Xi's visit immediately drew comparisons to an historic meeting in 1959. That's when hybrid seed pioneer Roswell Garst invited Nikita Khrushchev to Iowa amidst rising tensions of the Cold War. Garst believed agriculture was a gateway to prosperity between nations, and a doctrine dubbed peace through corn was born. But the men involved in the modern-day edition are nowhere near as bombastic as Khrushchev and Garst, and tensions were virtually non-existent.
There have become less and less farmers as the years have gone by, and so it is hard to stay in farming and hard to start as a beginning farmer. So yes, we're very interested in Grant continuing the farm, and if Austin is interested, he'll be the seventh generation farmer. We need them, they need us, and this world is changing. So we can't go back to the old days. We can't go back, and it's a free trade, free world. We're going to have to learn to deal with it and do what we can to be the person that they need.
In 2011, the multi-billion-dollar Chinese market surpassed Canada to become the top destination for U.S. farm exports. But American officials caution the agricultural sector against relying solely on one trade partner for growth.
But you still want to have a diverse portfolio. You don't want to be over-reliant on one customer because that customer can pull the rug out from under you.
But for now, China is rolling out the welcome mat for food grown in America. During Xi's visit this week, China signed agreements for the largest soybean deals ever made in a single foreign visit, offering another sign of China's tremendous appetite for U.S. grain. International experts predict Xi Jinping could assume the role of China's presidency in 2013. His country will undoubtedly continue to rely on American grain exports, and the future president will undoubtedly never forget about Iowa and the farmers that help feed his growing nation.
Look forward to future and long-term friendship.
期待着未来更长期能够保持这种友好。
是的，我们互相延续。
That is our wish as well.
Thank you.
祝你们。
For Market to Market, I'm Andrew Barr.
President Obama sent Congress a record $3.8 trillion election year budget proposal this week, calling for stimulus-style spending on job-creating projects and tax increases for the wealthy. While the Pentagon and a handful of other cabinet agencies would see their annual operating funds reduced, the proposed budget would leave health care programs for the elderly and the poor largely unchanged. The president would allow Bush-era tax cuts to expire for households making over $250,000 per year, raise taxes on stock dividends for Americans with the highest incomes, and institute a new minimum tax of at least 30% on those earning more than $1 million annually. Trailing only the Departments of Defense and Health and Human Services in its slice of the proposed budget pie, the Agriculture Department would see its coffers increased modestly. But that doesn't necessarily mean all of its programs will continue. The specifics of those cuts, however, and a litany of others, are likely to be addressed on Capitol Hill in the days ahead as lawmakers continue the arduous process of writing the next farm bill.
I think we're seeing that.
Preliminary work on the 2012 Farm Bill has been in progress for several months. The current law authorizing government farm programs was approved in 2008 and expires in September. This week, the Obama administration proposed a $154.7 billion budget for agriculture, an increase of nearly 5% over last year. Despite the increase, the savings of $32 billion over 10 years would be achieved through the elimination of some subsidies like direct payments to farmers.
As you consider the Farm Bill, I hope that you'll recognize the importance of streamlining the number of programs we have.
The idea of cutting the payments, which are made regardless of price or yield, was attempted during the Bush administration and was blocked by Congress. It remains to be seen whether the sacred cow will survive in an election year. But in the wake of the worst year for natural disasters in U.S. history, Secretary Vilsack still sees a need for a farm safety net.
55 million acres last year, through no fault of the producers, devastated by a natural disaster, a flood, a drought, a tornado, a fire. What do folks do, given the high cost of inputs? What do they do? One bad year can actually put a farm family out of business. So it's important and necessary for us to have some kind of support mechanism that allows them to reduce that risk.
Replacing the cash outlays would be a continuation of the Average Crop Revenue Election Program and a renewal of the Supplemental Revenue Assistance Payments Program. Another key safety net program facing cuts is federal crop insurance, which pays farmers through a combination of government and private funding sources. According to Vilsack, the administration feels private industry can better handle a higher percentage of the financial burden.
The president, when he looked at the agricultural budget, basically had to decide whether or not to focus on a balanced approach, an approach that basically took resources from farm programs, conservation programs, and nutrition assistance programs. He opted not to take money from nutrition assistance programs. In the president's view, these insurance companies are perhaps in a better position to withstand these difficult times than the folks who are currently struggling with tight budgets and can't afford to put enough food on the table for their families.
Some members of Congress and the Farm Bureau have raised objections over the proposed cuts. Farmers and ranchers often are identified as the primary beneficiaries of USDA's annual $150 billion budget. In reality, 80% of last year's budget was spent on social programs, like the Supplemental Nutrition Assistance Program, or SNAP, Women, Infants, and Children, or WIC, and other social programs.
Next, the Market to Market Report.
In addition to signing a plan of strategic cooperation with the United States, China committed to increased corn exports from Argentina this week as well. That news, coupled with favorable U.S. export numbers to other foreign markets, pushed grain markets higher. For the week, March wheat gained 14 cents, while the nearby corn contract moved more than a dime higher. China's announcements indicating it will purchase a record amount of U.S. oilseeds this year had bullish implications for soybeans. The March contract rallied nearly 40 cents, while the nearby meal prices advanced $12.50 per ton. In the softs, cotton also trended higher this week as the March contract gained 84 cents per hundred, and in the dairy market, nearby Class 3 milk futures lost 20 cents, while the April contract moved 32 cents lower. In livestock, the April cattle contract gained more than $4. Nearby feeder cattle advanced $5, and the April lean hog contract moved back above $90 with a gain of $2.07. In the currency markets, the euro lost 13 basis points against the dollar. Crude oil gained more than $4.50 per barrel, and COMEX gold advanced $8.30 per ounce. And the Goldman Sachs Commodity Index gained nearly 15 points to settle at 688.85. Well, here now to let us their insight on these and other trends, two of our regular market analysts, Walt Hackney and Virgil Robinson. Gentlemen, welcome back.
Thank
Virgil,
you, Mark. Thank you, Mark.
Walt, so many things to talk about. A lot of excitement surrounding Xi's visit, of course, from China here in the Corn Belt. Obviously, indications of more demand. Virgil was music to the ears of traders. Talked a lot about corn and beans because they were here in Iowa. Talk a little bit about this wheat market. Where do you see that part of the grain spectrum headed?
Mark, I don't sense any shortage of wheat, and I'll use for reference the recent World Supply and Demand Estimates report. They actually, Mark, increased wheat ending stocks, and I remember the number versus a year ago, increased it by about 12 million metric tons. So as kind of a benchmark representing supply, that stocks to use ratios in excess of 30%, and the U.S. at 40. So I don't sense at the moment any critical shortage of wheat. I do believe, however, it has some strength associated with other coarse grain markets, to include corn.
Absolutely. Talk a little about what happened in Easter. Very cold temperatures over there, no snow cover. Are you worried about production in that part of the world being reduced?
Yeah, I think it likely will be, Mark, but again, it's very difficult to quantify winter kill until a bit more time passes, break dormancy, and then the other factors that come into play agronomically there. But even if they were to lose a portion of that crop, Mark, I still think, at least as we visit tonight, that wheat supplies globally are certainly adequate.
Certainly seems that way. What about from a sales standpoint, a producer standpoint? What are you doing for wheat sales at this point, Virgil?
Old crop, new crop, Mark?
Let's start off with old crop.
Well, I'm guessing quite a bit of old crop wheat has been sold, and I think that's true. I do think that's true. If I still had old crop wheat to sell, Mark, historically, seasonally, there's normally a little improvement in price through the month of March, and I'd use that seasonality to finalize or certainly progress forward with old crop sales, and certainly use that same seasonal tendency to price some new or to minimum price some new, Mark, depending on the producer's ability to store at home and handle for any length of time. There are some carries that I think are attractive if a wheat producer does in fact have on-farm storage space, Mark, and an effort there could be made to improve profitability by utilizing that storage, the producer's capital, and then marketing skills.
All right. One question that Walter's wondering about, as am I, and that is the corn market. You heard the Vice President of China talk about a corn deal with Argentina, more corn demand perhaps from the United States from an export standpoint. We've got ethanol demand. We've got strong old crop corn prices. Optimistic about what demand could be in the new crop. What's your take on the corn market right now? And again, let's start with old crop.
Mark, again, the supply you've just outlined, or the supply scenario you have addressed, year over year corn supplies are down, and clearly that's underpinned the value of the market. I did note through the course of this week that the futures markets, the carrying charges from the nearby contract to those deferred, specifically May and July, narrowed or diminished again, Mark. So the market's flashing a pretty strong signal right up front that it needs that inventory. Now, interestingly enough, ethanol profitability has been stressed of late, but that's not to say some of the plants didn't do a good job of forward contracting their production, Mark, maybe used the futures market and hedged some of it. So there's still a demand pull there. But I'd certainly recognize the strength of the corn market as measured by lack of carry and strong basis. And if I were lugging old crop corn, I'd be inclined to move that, reward the basis, Mark. And if you want to be long corn futures because of weather concerns, and I heard you visit about that on your show this afternoon, radio-wise, a futures contract, some type of option strategy springs to my mind.
All right. The one thing we didn't talk about was feed demand. Walt, you've really pushed up these calves based on this kind of a corn price. Can we sustain that? What Virgil's talking about, this old crop's going to be tight. We're going to talk about new crop here in a second.
I don't know if the calf market is pressured as much by the prospects of higher corn as possibly short yearlings and yearlings. Calves are going to be subject to availability of roughage. And the more roughage, the better control you have on your cost of production, of course. With that being said, we cannot expect to see anything but a very bullish calf, short yearling, and yearling market for this year than what we have now, and possibilities of it going considerably higher.
All right. Roughage is going to be a key factor to it. I want to come back to this later, but let's talk new crop corn for all those cattle feeders out there, Virgil. What are your thoughts on that right now? Should we be locking it in?
Can they make a hedge here,
Yeah.
Mark? A profitable hedge? Certainly if they can, that's an option that they might choose, or some type of option strategy. The last I knew, that wasn't available because of inputs, right? So having said that, some type of option strategy is probably a better route risk management-wise than forward contracting without the prospect of a return.
All right, and riddle me this now. So old crop, you'd be unloading some, take advantage of the strong basis, take advantage of the strong market right now, concerned about the weather. There are these two camps out there, as you know, Virgil, on the weather side. There is this could be 1988 again in the Corn Belt camp, and then there's the camp that says plant in the dust, the bins will bust.
Yeah.
If we get 148 bushel average, or Katie barred the door price-wise, I don't know what it'll do from the demand structure, but if we have perfect weather, you could be at 165 bushel annual yield. I mean, you're looking at a lot of carry out then, aren't you?
Yeah, you would be, Mark, under those circumstances. You've probably illustrated and done a good job of bringing to the attention to our audience the use of crop insurance.
Right.
Very appropriate here under the circumstances, I think.
Deadlines are looming, right?
And we're in the process of establishing that February price as we visit, Mark. So that will come into play, and I think it will attract a lot of attention. It would be difficult to finalize the price of new crop corn, specifically because, and I've been in areas of late where new crop corn price is at or very near the cost of production in some areas, Mark. So clearly, and I think we've discussed this in years past, I'm always a little bit reluctant to finalize the price of new crop under these circumstances. So minimum price option strategies, and I know there's an expense attached to that, are more appealing and more flexible in my mind.
Absolutely. Real quick, soybeans, obviously with the Vice President of China's visit here, soybeans are on everyone's mind because they're such huge users. And of course, there's a lot of cooperation, a lot of smiles across the state of Iowa this week with his visits and his comments. What's your take going forward on soybeans?
Mark, a couple things. The crop in South America in each of the last two world reports has in fact declined. So there remains obviously a concern there. And year over year, ending soybean inventories are projected to decline about 9 million metric tons. So that's underpinning the price of this particular commodity. I think there's something of an acreage battle looming, particularly with the recent change in the new crop soybean, new crop corn price ratio. So old crop beans, Mark, if I had any, I don't have any. If I had any, I would be patient if my balance sheet permitted that,
right. Yep.
and sustain that inventory moving forward for at least a while longer. Minimum price comes to mind with respect, and/or insurance programs with the new.
On new crop. All right. All right, let's shift back over to the cattle market. We're talking about this calf market and not a lot of profitability, what you're saying right now, but your bigger concern is finding the calves. What about this wild fat cattle market? This is a big day on the futures on Friday. What's going on here, Bert, as you look at this thing tonight, Walt?
Mark, I've been in this studio for over 20 years. I've been in this market aggressively since 1959. I consider myself fairly well versed on trends and what to expect. And as we speak, I have no opinion.
Okay, that'll wrap up this week's show. You have some opinion because I know you're out there doing it right now. What are you telling people on this fat cattle market?
I'm telling them to sell cattle.
Mm-hmm.
What all of us have got to understand is at $1.29 as we made today in the cash market, some of those cattle lost money.
Right.
What we fail to understand is that feeder cattle are nearly daily making historic highs in their cash market. And I heard Virgil talking about hedge. I heard Virgil talking about risk management. You better have a plan of some kind of protection. Now, I don't know that a hedge is the proper protection. Yesterday, as we speak, the best money in the country from West Texas to Illinois was $1.22 bid by Packers. $1.27 asked by cattle feeders. This morning, at the break of the market when it opened, $1.29 was paid. Now, why have we got a $7 disparity from yesterday to this morning? And why in that disparity would a packer possibly do that if they were, according to their comments, losing the phenomenal money they claim they have being lost in the beef industry? I honestly don't know. I tell my customers, I tell my people, if you've got the corn under control, if you've got corn that you can market at $8 a bushel or $7 a bushel through cattle, that's as good as selling it to the elevator if you can insure yourselves that way.
All right. Walter, the hog market, I got about a minute left. What's your take there? We got more hogs. You told us we'd have that, and most recent reports have confirmed it. How much we're going to be selling them for?
Well, I think that the hog thing has got to be addressed in return of cash flow to the hog producer. Everybody has been waiting impatiently for export to increase. It hasn't necessarily done that. The producer caught on back in the midsummer when the corporate mega producers were building hogs on the feeding floor, wait, anticipating export. That's what they're doing today, is building weight with the producers.
Absolutely. All right, we'll talk more later. Walt Hackney and Virgil Robinson, thank you so much. That'll wrap up this edition of Market to Market. If you'd like more information from Walt and Virgil on where these volatile markets just may be headed, visit the Market Plus page at our website. You'll find expanded market analysis, audio podcast, streaming video of our program, and links to our Twitter feed and Facebook page. And by the way, it's all free at the Market to Market website. And be sure to join us again next week when we'll examine efforts to fight glyphosate-resistant weeds. So until then, thanks for watching. I'm Mark Pearson. Have a great week.
Market to Market is a production of Iowa Public Television, which is solely responsible for its content.
Funding for Market to Market is provided by Pioneer Hybrid, which supports efforts to help families pass their farms into the hands of the next generation. Pioneer, science with service, delivering success.